Welcome back to Accounting 401, Chapter 7, where we will be discussing investments. Um, there's an overview, key facts at the beginning of the chapter, page 7-2. Very important. Take a look at that. Uh, Sets everything up. The investments can be anywhere from taxed at ordinary rates to being tax exempt. And in between, we have the tax at a preferential rate. We'll talk about those in the upcoming hour and a half it takes to get through this chapter. You can also have pay tax annually on things like dividends that are coming in annually if you own stock, and then if you sell the stock, the tax will be deferred until you sell it, even though it goes up and down through the years. Hopefully it goes up. Not every investment goes up. Some go down. Some you lose your money. Take for example I have a couple shares of Hershey Company, the candy maker, down 90 miles, 100 miles down the road from here, and I paid $45 for it. It is currently in excess of $200 per share. It makes my net worth go up, but I don't pay any tax until I sell those shares and realize the gain. It's a paper, what they call a gain on paper. Yes, it's worth more than I paid for it, but until I sell it, I will not realize that gain. So it's in that sense, it is tax deferred, even though I've owned it for 20, 25 years. It has gone up over those times. I don't pay it as it goes up. I only pay it in the instance when I should happen to sell it. Sometimes we lose money. Well, we'll talk about how we deduct those losses from investments when we lose money in an investment. Then the thing is the rates. We already talked about that. Ordinary tax rates, preferential rates, or zero tax exempt investment, which would be municipal bonds are exempt from federal taxation. Now, investment income is different from earned income, because earned income we have to put forth a effort. We have to, sell our labor, our talent, or a product. Meaning we're out there or we're in a store waiting for customers to come in. We're advertising. We're engaged a whole lot more. Investment income comes about more from the fact that we own something and we are not working at it full time. Although there are investors, and that's a special situation because that rises to the level of a trade or business. But for most people that are working at a day job and they are adding investments on the side, whether it's a rental property or a oil or gas well, or stocks or bonds, or just different savings accounts, the amount of income that is generated is not through the efforts of the individual owner, but rather the fact that the owner, the person, the individual taxpayer, owns something and is able to take advantage of what they own. Okay, tax investors should be concerned with after-tax return. That is why you'll see municipal bond rates are usually lower than the rates on corporate bonds, because the fact that they are tax exempt. And the theory there is Congress says, why should we make government have to pay a lot of interest when they borrow money? We will just make their interest that they pay on their bonds, on their borrowing, tax-free, and then they could sell it at a lower rate. And depending on your tax bracket, that could be very advantageous. A lot of people in high tax brackets, high marginal tax rates will invest in municipal bonds versus corporate bonds because it'll give them the same or a higher yield. Income from portfolio investments. Portfolio investments are things that produce dividends, owning stock, interest, having money in a bond or a bank account, royalties, that would be having somebody harvest your timber and paying you some of the proceeds, oil or gas wells, you own something, and somebody, usually in one of the extractive industries, will pay you a fee. Years ago, with the oil companies, the big sisters of I forget what it's big six or big seven oil companies. One of the reasons the Arabs are upset with us is they didn't think they were getting a fair shake. I forget if it was 1/6 or 1/8 of the proceeds uh, they got paid, and they didn't have to do anything. They just let the company come in, do the drilling, pump the oil out, transport it out, pipe it out, truck it out, however they did it, refine it, sell it, market it, all that stuff, and they just got paid a royalty payment. Like I said, it was 1/6 or 1/8. I forget exactly what, for doing nothing, just having somebody give them the right to access the land and drop a well down and hit something, hit gas or oil. And we have annuities, which are a series of payments, usually an insurance contract to some employer. You make an investment, and they guarantee they will pay you X number of dollars for X number of years. Uh, Capital gains, that's what I was referring to earlier, where you buy a stock or a bond and you hold it for a while and sell it at a price higher. That would be a capital gains. And we'll get into it, whether there's two types, short-term and long-term. Short-term is if you hold it for a year or less, it's a short-term capital gain. If you hold it for a period longer than a year, one day, it becomes a long-term capital gains. Short-term capital gains are taxed at ordinary rates. Long-term capital gains get taxed at a preferential rate, lower, depending on your tax bracket and your AGI. That rate can be anywhere from 0 to, I believe, 20%, maybe 15. I'm not quite sure on that. It changes from year to year sometimes. I don't know what the current one is, but we'll see what it is on for this book, which would be applicable to, I believe, the 2021 tax year, even though it's a 2022 edition. Okay. In contrast to portfolio income, we have what we call passive investments that generate operating income and operating losses. Passive investments are direct or indirect investments other than through a C corporation, that's a regular corporation, in traded business or rental activity in which the taxpayer does not materially participate. I own well, they're not shares, they're owned, they're called units in a limited partnership up in New England. And it's actively traded on the New York Stock Exchange, even though it's not stock. A lot of people call it stock, but technically it's not stock because it's not a corporation. I don't do anything for that corporation. I'm an owner. I own a very, very, very small part, only a millionth of a percent. It's a pretty big company. And I don't have to go and shovel snow. I don't have to do any of the ordering. I don't have to do any of the selling. I'm never working the register. I have no connection with it whatsoever. In fact, I live, 300-400 miles away from it. And all I do is own, and it generates income for me. Sometimes it will generate a loss, which I can use we'll get into that, how that works. The most common thing here with the passive investment is if you have a rental unit, which years ago I did. Very nice way to earn some extra cash. Again, you sock down a pretty good amount of money to buy a house or a duplex or a townhouse or whatever, and you rent it out to somebody. And, you have various deductions associated with it. And one of the big ones is depreciation. And so you get a lot of pretty good cash flow from it. And the depreciation is a non-cash expense, so it lowers you. You go from your gross rental down to your net rental, and you get taxed on that. The only thing is when you sell it, what those depreciation, and we'll see this in later, I believe, chapter 10, when we're talking about disposition of assets. When you sell that property, all the depreciation that you deducted comes back as ordinary income, and then with the adjusted basis, the amount above that would be a capital gain, if any. Could also be a capital loss. But again, I have one unit. Back when I prepared taxes for people. I had one client that had 5 units. She had a full-time job too. But once you start getting quite a number of them, in fact, I know a guy who's a plumber, and he has 20 some units. That is almost rising to the level of a second trade or business. The IRS could make the case. He'd have to make the case. Now these are all passive investments. I'm not there every day managing those properties. I do some work on them, but it's not my main principal source of income. My day job is. And we'll look at the rules for those things too as we get through this chapter. Again, a thing to establish here is that investment income can take many shapes and forms, and as many shapes and forms are there are just as many tax treatments for them. So the first one we come to is portfolio income, interest, and dividends. A lot of people are familiar with this. Interest from bonds or savings accounts, insurance policies or contracts, dividends from owning stock. Okay. Interest is taxed as it is credited to your account or received at ordinary rates annually. Okay, because the payments are made either quarterly or twice a year or once a year, depending on the bond or the contract you have. In fact, if you have a certificate of deposit at the bank and you let the interest accrue, let's say it's a 5-year CD, each year they pay you interest and they put it added to the principal of the certificate. So you don't get your hands on it until the certificate matures in 5 years. Despite that fact, you still have to pay yearly interest, as it was. You could have opted to have it paid to you. You instead said, put it in. I do that with my dividends. Just about every investment I have a dividend reinvestment option, and I don't get the dividend check. I say, give me more shares of stock. And I still have to pay tax on that dividend as if I did take a distribution in cash. So the IRS, it says, you have the option. It's constructive receipt. I rather have the stock, the dividends buy me more stock because I get more stock without having to pay a broker's commission. And if I like the company enough to invest in it originally, why don't I like it now? I may as well take advantage of that. I really don't need the dividend income, so turn my investment into making me more shares that I have invested. Savings bonds are taxed at the sale or maturity. Accrued market discount is taxed at the sale or maturity, so those would be deferred items. The tax is deferred until you sell the investment, and the original issue discount is taxed annually as it is earned. Okay. Underneath that, they get into little specifics with the certificates of deposits at the bank, corporate bonds, savings account, government bonds. Now, federal savings bonds the interest on those are taxable. They're exempt from state tax, but they are not exempt from federal IRS taxation. I can't scroll up here. I got the little thing right over the cursor. There I go. Mutual funds. It depends on what the composition of. Some of them have both. Some are just bonds, some are just stocks, some are a combination of stocks and bonds. So you'll be getting your share of the dividends and your share of the interest reported to you on a Form 1098. At the end of the year, you'll have to include that in your taxable income on your 1040. By lending money to banks, government entities, and corporations, investors essentially become debt holders. Yeah, it's a debt security. As opposed to equity security, where you are an owner. Here you are a creditor. As such, they are legally entitled to receive periodic interest payments and to recover the amount of the principal amount loaned. Again, you put $100 in the bank. Let's say the interest rates are 5%. At the end of the year, you have $105 in that account. You close that account out. You don't have $105 of income. You only have $5 of income. The interest paid. The $100 is the cost of your initial investment. So there's no tax on the recovering the cost of your original investment. Okay, that's what they're talking about. The maturity, the bonds are traded in the market just like stocks. The prices go up and down depending on what interest rates are doing. Okay, so if you buy a bond that has a 4% rate of interest and the market rate of interest is 5%, the value of your bond goes down. And the converse, if the rate of interest goes down, what did I say? The bonds are at 4%, and if the market rate of interest is 3%, the value of your bonds goes up because it's paying a higher rate than the market or a lower rate than the market, and then the price goes down. So if you sell it, you could get what you paid for it. You can get more than what you paid for it, or you can get less than you paid for it. If you get more, it's a gain. If you get less, it's a loss. If it's the same, it's a break even or wash situation. So there'll be no tax, although you'd have to pay tax on the interest. Special rules apply for determining the timing and amount of interest from bonds when there is a bond discount. That is when the bonds are sold or issued at an amount below their maturity value. So at maturity, you're going to get the face value of the bonds, usually $1,000. If you bought it at its outset, say for $900, well, that affects your actual interest. Even though the bond, $1,000 bond is 5% interest, we'll be paying you $50 interest a year. Your actual interest income is higher than that because you didn't pay $1,000 for the bond. You only paid $800. So the yield is higher than 5%. So that has to be factored in to your computation of interest income. Okay. And corporate bonds and U.S. Treasury bonds. Treasury bonds, Treasury notes are issued at a maturity value, at a discount or a premium, depending on where the rate on the bond is relative to the market rate of interest. So that will affect the interest amount the interest income you are effectively receiving. Even though it's a set amount based on the interest rate on the bond and the principal of the bond, what you actually pay for the bond will affect your actual interest income or your yield. There are things called zero coupon bonds, which are bonds that do not pay interest but are sold at a steep discount. Let's say a $1,000 bond, face value, maturity value, would sell for like $400, $500, $600, and it doesn't pay you any interest, but at the maturity date, you get $1,000 value for it. Well, that is effectively interest rate going up. It's not capital gain. Okay. If the bond was sold at a premium, if the bond was sold at a discount, they're required to amortize the discount and include the amount of the current year's amortization and gross income. Okay. Of interest income. If it was sold at a premium, you have the option to amortize the premium, or let's see, taxpayers or their advisors are responsible for determining the amortization. So you can figure that out on the computer. There's programs available online. The amount of the current year's amortization offsets a portion of the actual interest payment. You must include in gross income, so you can lower the income there if you paid above market value or above maturity value for the bond. The original tax base of the bond includes a premium and is reduced by any amortization of the premium over the life of the bond. Each year you hold it till maturity. If the bond is purchased in the secondary market, that means you buy it from another person. There's two markets out there, the primary market and the secondary market. The primary market is when the bond or stock sells for the first time. That's the only time the company that issues the stock or the bond gets any money. The secondary market is when the bond trades on the market between investors. The company has nothing to do with it. Okay. That money, I sell you my bond. That's the secondary market. I bought the bond from the issuing company. That's a sale in the primary market. So if you amortize the market premium, let's see, the bond is purchased in the secondary market at a premium. The premium is treated exactly like the original issue discount premiums. Okay. So you reduce the annual income received on the bond by the amount of amortization. So you can minimize your tax a little bit there. U.S. savings bonds issued at face value or a discount, and they do not pay periodic interest. Rather, they accumulates over the term of the bond, and it's paid when investor redeems the bond or the bond matures. Okay, so the amount of interest income they recognize when they redeem the bond. So this is a situation where you can defer income. The trouble is, if you have the bond for 5 years or 10 years, you're going to get 5 or 10 years of income all in the 1 year, the year you redeem, the year the bond matures, or the year you sell it. If you do it yearly, you could spread it out and soften it. Again, you have to pay attention to this because timing is very important. If you do it in a year where you retire and you get some retirement incentives, you push up brackets and you end up, I'm not say paying through the nose, but paying a lot more tax than if you weren't paying attention and say, hey, I'll sell these bonds a year before I retire, or I'll sell them the year after I retire. So when I get a payout of my unused sick time or something like that, it won't be at my higher incremental tax rate. Interest from Series E, EE bonds, and Series I bonds are may be excluded from gross income to the extent the bond proceeds are used to pay qualifying educational expenses. So you can defer it, or you can exempt it if you use it for educational purposes. However, the exclusion benefit is subject to a phase-out period based on the taxpayer's adjusted gross income. All right, so I think it's kind of unfair. Why, again, they want rich people to pay more taxes, so they don't give them that break. But it's the same thing. Why not treat everybody the same and let them all use it for being tax-free if they use it for educational purposes? Again, if you get somebody educated, the stats show that the person will make more money over their lifetime, and they will get more tax from that person than had the person not gotten an education, whether it's a trade school or a truck driving school or a college or university, or a trade school, plumber, electrician, carpenter, what have you. Certain types of investments, such as savings account, money markets, and CDs, computing the annual taxable interest is relatively straightforward. So, plus you'll get a 1098 from the issuer. Dividends. You got to be careful here a little bit because there are two things we have to consider, or two types of dividends. There's qualified dividends and non-qualified dividends. Okay, what's a qualified dividend? That is usually a dividend from any domestic corporation or a qualified foreign corporation, and those dividends would be subject to preferential rate, lower the capital gains rate, and the capital gains rate varies depending on your AGI, your taxable income. If you're on the lower end of the income level, your dividends will be taxed at zero. So they could be tax exempt if you're in a lower tax rate. There's a table in the appendix in the back of the book that'll show you where the qualified rate, preferential rates on dividends are, depending on what your marginal tax rate is. It's always at least 1 or 2 lower than your effective tax rate for your ordinary income. Qualified dividends are those paid by IRA, and you have provided that the investor holds that stock for more than 60 days. During a 121-day period, that begins 60 days before the ex-dividend date. The ex-dividend date is the date in the middle, and is a relevant date for determining who receives a dividend from a stock. Anyone purchasing the stock before this date will receive the current dividends. Otherwise, the purchaser must wait until the subsequent dividends are declared to receive them. So, who owns the stock as of a certain date is the person who gets the dividend. Okay. Non-qualified dividends are not eligible for the reduced rate and are therefore taxed at ordinary tax rates. And again, that would mostly be, there's a couple oddball American corporations that would have that, non-qualifying dividends, or any foreign corporation that does not meet the criteria for paying a qualifying dividend. The Form 1099-D will be sent to the holder of the stock by the company, and right in there it'll say in the block whether it's a qualified dividend or a non-qualified dividend. So it's very easy for the preparer Just follow what the 1099 says. Don't have to do a lot of research and digging to see whether it's a qualified or non-qualified. The Form 1099 that tells you the amount of the dividend will also identify it either as qualified or non-qualified. All right. Sounds complicated, but it's not. All right, portfolio income, capital gains and losses. Okay. Well, you get capital gains when you sell a capital asset. Capital asset is, come on. In general, a capital asset is any asset other than an asset used in a trade or business, or an asset such as an account or note receivable, note receivable, or inventory acquired in a business from a sale of service or property. Okay. Basically, what capital assets are your stocks and bonds, your investments. So it could be your rental property. It could be a personal asset, jewelry, a vehicle, what have you. Okay. Let's see. They say, examples: raw land, fine art, rare coins, precious gems or metals, growth stocks, stock and corporations that reinvest their earnings to grow their stock price, mutual fund shares, even vintage automobiles. This is talking vintages. You can even say a vintage wine collection. Okay. Purchasing any such assets not without risk. Some of those things can go down in value. Okay. In which case you would have a capital loss if and when you sell it. Scroll down here a little bit. Okay, so when you have a capital assets, the gains are deferred or put off until the future for tax purposes until the taxpayer sells or otherwise disposes of the asset. You can donate it to the university or to some other charity. And the gains are generally taxed at preferential rates relative to the taxpayer's ordinary income, their marginal rate. Why the favorable tax treatment? Well, Congress says this is a good thing for people to invest money to grow the economy, to grow companies. So they encourage it. One reason they let the deferral is so they don't overburden the taxpayer. If you tax it year by year as the price appreciates, where is the person going to get the cash to pay the tax? So Congress figures when they sell it, they'll use some of the proceeds from the sale to pay the taxes. Okay. The other thing is, again, incentive to invest in assets, to grow the economy, stimulate the economy, and they get a benefit by holding it and selling it. After they hold it for a period of 1 year, they get the preferential treatment. However, when they sell a capital asset at a loss, the ability to deduct the loss may be limited. Okay. What we use to determine gain or loss when we sell a capital asset is whatever the tax basis of that asset is, which is nothing more or less than the cost we paid for it and any depreciation, amortization we have is deducted in conjunction with that capital assets. That's referred to as the adjusted basis. Tax basis, adjusted basis, pretty much synonymous in most over 90% of the cases. Again, gross proceeds, any costs of selling it are deducted from the proceeds to determine the gain or loss. Yeah. Bitcoin, the taxes in the world, they want to invest in Bitcoin. No, I don't. I don't understand it, and I'm a little bit leery of it. Maybe, again, don't put your hard-earned money into investments you don't fully understand or are comfortable with. But the IRS does recognizes Bitcoin, or not only Bitcoin, but any of the cryptocurrencies. They recognize them as a commodity and not as a currency, because trading currency has separate rules. So again, you can see right there about 1, 2, 3, 4, 5, 6, 7. 7-8, line down, interest in the IRS says a virtual currency is property and not currency. Okay. Okay, when you're selling stock, by default, you use the first in, first out method. That's what the IRS will apply, meaning the stocks you buy, like I said, I have dividend reinvestments with nearly all my equity holdings. So if I sold any, they would say, you're selling the oldest ones first, not the most recent ones. So again, it'd make a big difference because the most recent ones I have for Hershey, I paid over $200 a share. The older ones I paid, I think, $44, $45 a share. So, if I sell it for $250, I'd have a $205 gain on the older ones. On the ones I bought through my dividend reinvestment plan, I would have $5 or $10 or $20 gain per share. The alternative, the taxpayer has the option of using the specific identification. I could say which ones I wanted to sell. And in fact, it not only has an implication on the amount of the gain or loss, it would also have implications whether that gain is a long-term capital gain or short-term capital gain. Again, short-term is going to be taxed at ordinary tax rate, whatever my marginal rate is. Long-term capital gains is going to get preferential treatment. Preferential rate. So it usually behooves the seller to use this specific identification and say which ones they're selling. The ones I bought on this date, that date, or the other date. They give you an example there. You read through that. That's kind of neat. They had $8,000 on the sale of stock, $40 per share, 200 shares sold. And the difference between FIFO and specific ID lies in the amount of taxable gain on the current sale, and also whether it would be long-term capital gains or ordinary income, short-term capital gains. Types of gains or losses. Short-term capital gains or losses, as I said earlier, that is those ones that are sold. If you held it for 1 year or less, it's a short-term capital gain or loss. To be a long-term capital gain or loss, you have to hold it for a period of more than 1 year, 366 days or more. Okay, there they are. Don't even have to go back to the appendix. They have the rates right there. For the Exhibit 7.3 is the tax rates. Okay, so depending on your taxable income and your filing status, you'd be in a certain bracket, and you can see that the highest bracket is 37%, but the highest rate for capital gains is 20%. 15%, depending on your taxable income and your filing status, or even anybody making less than $54,000 if they're head of household, under $40,400 if they're single, and the same amount for married filing separate, and double that, $80,800 for married filing joint. Your long-term capital gains rate is 0. There's a little quirk there in the last couple sentences above Exhibit 7.3. Be sure you read those 2 or 3 times. So the maximum capital gains rate is between 0 and the maximum 15%. Long-term capital gains are taxed at 15. Maximum rate amounts often referred to as breakpoints. When the income is above the 15%, long-term capital gains are taxed at 20%. However, certain long-term capital gains are taxed at a maximum rate of 25%, also known as unrecaptured 1250 gain, Section 1250 gain, while others are taxed at a maximum rate of 28%, specifically gains on collectibles and gains from qualified small business stock. So they get a little bit higher rate, but it would still be a preferential rate. Now, if your ordinary marginal rate is lower than that, it'll be taxed at that, not at the higher rate. The Section 1250 gain. Section 1250 deals with the sale of real estate, and there's very small likelihood that you would encounter this because it was under the old depreciation rules, and most of that property has already been gone for a decade or so. But if you have stumbled across that, just keep in mind that it gets taxed at the maximum of 25%. And then we have the 28 on certain other things, 1202 small corporation stocks and collectible items. I'm looking here in my house. My wife has a collection of Hummel figurines and plates. I don't know what they're worth. I don't know where we paid for them, so we'd be in a pickle if she sold it. There's a summary there in Exhibit 7.5, classification of capital gains by maximum applicable tax rates. So short-term, long-term, and there's the rates there. Short-term, as you can see, the highest marginal tax rate is 37%, so they're subject to ordinary income. Long-term capital gains, highest would be 28%. And then look at those asterisks down the bottom. Okay. Qualified small business stock, held less than 5 years, or I'm sorry, greater than 5 years, 14%. Unrecaptured Section 1250 property from recent realty, 25%. And again, read the asterisks underneath. Long-term remaining capital gains, 1231 is not included elsewhere, 20% max. Okay, the netting process.